All right, the Federal Reserve just cut interest rates by 1/4%, which that's the third cut this year. And after similar moves, we had cuts in September and October as well. So this is a slow, gradual easing trend. It's not a big emergency slash 100 basis points or anything like that. But here's where it gets interesting. So the vote inside the Fed was actually split. One member wanted a bigger 0.5% cut or 50 basis points. Two members, they didn't want any cuts at all. So that's the biggest disagreement that we've actually had inside the Fed. So what does this mean for you? And then, of course, for mortgages and mortgage rates and the housing economy. So first, mortgage rates, they don't move in a straight line with the Fed funds rate. Like it's just not the same thing, apples and oranges. They follow what investors expect for inflation and the broader economy, not just what the Fed does in one meeting. And because this cut was widely expected, a lot of the cut for mortgages was already priced into the bond market. So mortgage rates may not drop overnight just because the Fed moves rates a 1/4 point. It doesn't work that way. In fact, on some recent cuts, mortgage rates, we've talked about this, have actually gone up. They stayed flat or they've ticked here or there just a little bit based on the Fed comments. That's about it. And secondly, the outlook the Fed gave for 2026, what really matters because right now they're only projecting one more small cut next year. And some members are still arguing for no more cuts or even a possible hike next year. So that tells you the Fed is not convinced that inflation is fully tamed and under control. This means likely the windows of opportunity where rates dip and then bounce rather than a smooth decline. So it's going to be an interesting 2026.